Hello, Avila Advantage Microeconomics students. We are now in week 4, so after the end of this week, we are officially halfway done with this class. So it does move quickly, so just keep plugging along. Great job with the forum discussion this past week on the counterfeits or the faked. I really enjoyed looking at your post. For the forum discussion this week, what I want you to do is based on the paper you just finished for your company analysis, I want you to share briefly with the class those questions that I posed in the assignment, some of the answers to those questions, and then I'll make sure to include your sources that you had for your paper in your initial post, and then make sure by Friday to respond to at least one other person with a comment or probing question, and then by Sunday make sure to post to one more peer, so you have a minimum of 2 peer posts. But I'm looking forward to see what you've learned about your companies. And as we kind of change this week, we start to look at chapter 7 and 8. We're looking more at the cost analysis and our first market structure. So the two are intertwined together because it's getting to the ultimate question, how is the firm going to add value? How are we going to utilize our resources? What type of market structure are we exposed to? Is this perfect competition, monopoly, monopolistic competition, or oligopoly? So just keep plugging along with the assignments and the homework, and stay on top of things. You'll do fine. So first, with discussing some of the learning objectives for Chapter 7, the first one discusses the idea of explicit and implicit cost. Explicit is a little bit easier to understand. Explicit are the things that are hard dollar that we can measure. So example for like a labor cost is an explicit cost. Implicit cost is an opportunity cost. And generally in economics, we view this as an opportunity cost from the investor's perspective. If the investor expected a 7% rate of return on their investment, that's what the company needs to at least be making in order to truly break even from an economic perspective. So when we look at these cost curves this week, and when you're looking at that average total cost curve, we're going to make some assumptions with that cost curve. We're going to say that it includes both the explicit cost and the implicit cost, the required rate of return for our investors. And if we are just covering all our explicit and implicit, that's called a zero economic profit, kind of a break-even point, or a normal profit. If you're doing above and beyond that, that's called an economic profit, and that's a good thing. But if we're doing below that break-even point, that's an economic loss. We might even be making a profit from an accounting standpoint, but if we're not making one from an opportunity cost, the investors will go out and seek or give their money to someone else and look for those returns. So that's an important concept in economics. With the discussion of cost, you're going to talk about fixed cost and variable cost. In the short run, we're always going to have some fixed cost, but in the long run, all costs can be variable. In the short run, you may have signed the lease for 3 years, so that could be your short run. But once the lease expires, you might be able to get out of the lease or may go to a bigger building. So you have choices and things become more variable. But rent is a good example of fixed cost. Sometimes salary is a fixed cost. But I want you to think about fixed cost as like the very minimum that you have to have before you even produce anything. So it might be example like a certain amount of plant and equipment or capital or a building that you have to start off with. So you're still going to pay rent even if we don't produce any goods or services. Variable costs are going to change as our what we call the Q, or the quantity, starts increasing. So whether it's a good or service, as that Q changes, you're going to see increases in the variable cost. So total costs together are going to be fixed cost plus variable cost. And if we divide each one of those terms by Q, or the quantity, that's where we come up with the average total cost is equal to average fixed cost plus average variable cost. And what you're going to notice in the readings this week is both the average total cost and the average variable cost have this U shape to them. And the reason they have this U shape is what we call diminishing marginal returns. The idea that if I have a fixed plant and equipment in space, at least in the short run, that if I keep adding more and more of an input, say labor, with a fixed amount of input, such as a building, I can't expect that production is just going to keep going up and up and up. There's some diminishing returns. I like to use the example of vegetable garden. If I add a certain 12 by 4 vegetable garden, More fertilizer is probably going to increase production, but if I keep adding more and more fertilizer, it's going to start costing me more, and it may actually have damage. So I might reach a maximum amount of vegetables that I can have in the garden, but I keep doing it, I may actually make myself worse off. So this is why we have the U shape to the cost curves. And what they're also going to have there is marginal cost, which by definition is just the change in total cost divided by the change in Q, or what we call quantity. Okay, so you're going to spend a lot of time in your readings that chapter understanding the cost curves. If I were to look at scenarios of different short-run cost curves for different scenarios, that's what we call the long-run average total cost curve. And they give you an example in the readings which we call economies of scale, when our costs actually start going down as we produce more. Look for efficiencies. We may have like a constant returns to scale, and at some point we could actually experience diseconomies of scale, where per average total cost is actually starting to go up. And there can be various reasons for this. Imagine if Budweiser produced all the beer in St. Louis. Well, that would not be practical, because they'd have to have truck drivers go all across the United States, and things could be very expensive. So Budweiser strategically locates their plants throughout the United States, and probably in a way to do it at the lowest possible cost. And they have distribution centers to get the beer out to all the consumers. So a lot of thought is put into cost, and especially in trying to utilize resources. How can I do this what we call economically efficient? There's technically efficient. How can I do this with the least amount of resources? And there's also economically efficient. How can I do this with the lowest possible cost? And sometimes that's decisions between different amounts of labor and capital, and what's going to cause my cost curves to drop so I can potentially make more profit. Okay, so how this ties into Chapter 8? We go to Chapter 8, we start to look at the first market structure this week, and that's perfect competition. And we're kind of tying everything together now, because what you'll notice in your readings is that a perfect competitive firm, the characteristics, they're a price taker, there's considered perfect information, it's a homogeneous product, basically wheat is wheat. And because they are a price taker, within the markets, price for wheat is established, so supply and demand. But if for the firm itself, think about a wheat farmer, their demand curve is going to be perfectly flat. It's going to be perfectly elastic, because they have to accept the price that's established in the market. And because it is a perfectly elastic demand curve, plus because it's a flat demand curve, as the more they sell, the total revenue is always going to change the same, and the marginal revenue is always going to be the same. So the demand curve and the marginal revenue curve are one and the same in perfect competition. That's very unique about this market structure. But the golden rule, at least for monopolistic competition, monopolistic for perfect competition, is that we're going to maximize our profits where marginal revenue equals marginal cost. So if I'm a wheat farmer and I see that I'm going to get another $5 a bushel for that next bushel of wheat, and it costs me $3 to do it, I'm going to make $2 on it. So I'm going to produce that next bushel. The next bushel I get $5, and now costs me $4. Well, I'm going to make $1 on that. But if on the next bushel I get $5 and it just costs me $6, well, I'm going to stop there, because now my marginal cost is exceeding my marginal revenues, and that's why by definition we're going to choose the output of production where marginal revenue equals marginal cost. And you're going to see this where the marginal cost curve intersects that marginal revenue curve, and that's the quantity we're going to produce. Now, the other thing with this, in perfect competition in the long run, the price should always equal average total cost. But there might be some different scenarios, and that's what the textbook goes through, that, what if I have price above average total cost? Well, that's a great thing. That's economic profit. But in perfect competition, that's not going to last for a long time. Others are going to enter the market, and as they do, the supply curve shifts out in the market, and the price is going to drop. So that kind of elastic demand curve is going to go down to a point where the price is just equal to average total cost again. If the price is in between average total cost and average variable cost, we want to continue to produce in the short run to at least cover some of those fixed costs, because the difference between that average total cost and average variable cost curve is the average fixed cost. And then finally, if we are at a point at average variable cost with our price is equal to average variable cost or below average variable cost, that's what we call the shutdown point. So if you hear about stores like, say, a restaurant shutting down, or particularly, I think it was like this past week, I think I read about the Sporting Authority, a sports store, that's basically going bankrupt and they're shutting down the store. So their price relative to their average variable cost is below average variable cost. So that they're actually making themselves worse off, and it's just better off filing for bankruptcy and shutting down. And sometimes that happens in markets. Business is always changing, markets are always changing, so firms really have to be innovative and be able to adapt to change. If they don't, you're not going to be around in the long run. Okay, so that was a brief summary for the items that you're going to read about this week. Do email me if you have any questions relative to the homework or the concepts. But otherwise, have a great week, and I look forward to reading about your company analysis and talking to you online. Take care.